If the only reason you're buying a stock is because you think it will go up, then you shouldn't buy it at all. The secret to investing isn't learning to trust your gut, it's learning to ignore it. Before buying a stock, do your homework. Spend at least as much time researching it as you would when choosing a new refrigerator. Buying a stock is like choosing a life partner. Divorce shouldn't be the first thing on your mind. You must know exactly what you're buying and why. Fake optimism like this baby will grow up fine, just won't cut it. A stock is not a lottery ticket. It's partial ownership of a real business. The ideal company is one that even a fool can run because one day a fool probably will. And that's exactly the kind of business I dream of investing in. Finding great companies is like looking for bugs under rocks. You may need to flip over 10 stones just to find one. Research 10 companies. Maybe you'll find one good stock. Look at 20, maybe two. Look at 100. And you might find 10. In the game of investing, those who do the most homework usually win. Don't spread yourself too thin. Owning stocks is like raising children. You need to stay within your limits. An amateur investor can realistically follow about 8 to 12 companies. Don't own more than 5 stocks at a time. When analysts get bored, it's probably the best time to buy. If you know how to do 5th grade math, you can understand market trends. I've found that when the market drops and I buy a solid fund, I often thank myself years later. Every stock represents a company. Stocks only rise for one real reason. The company improves either from bad to good or from small to big. If you understand why you bought a stock, you'll also know the right time to say goodbye. Trying to find a big winner in a quiet, comfortable room is like expecting a detective to solve a crime without leaving the couch. It's just not going to happen. When a stock becomes attractive, buy it. Yes, it might go lower afterward. I once bought a stock at $12, watched it drop to $2, and later it shot up to $30. The truth is, you rarely know where the bottom is. Math can help, but practice matters more. The key to making money in stocks is to not let them confuse or scare you. If you're buying a troubled company, make sure it's one with strong finances. Avoid those drowning in debt. The market will go down sometimes. If you can't accept that, you shouldn't be investing. Instead of worrying about the market crash, ask yourself, will people stop buying cars? Homes are eating out. If not, then the world isn't ending. Amateur investor treats a market crash the way a Minnesotan treats winter. They know it's coming and they're ready for it. Investing isn't like science. In science, understanding leads to answers. But in investing, if you wait until you fully understand everything, the stock may have already quadrupled. You have to take some risks. In the short term, a company's stock price often has nothing to do with its performance. But in the long term, performance and price are perfectly aligned. Knowing this difference is key to success. Patience and selecting great businesses win the game. Never invest in a company if you don't understand its financials. Investors often lose the most on companies with terrible balance sheets. Before you buy any stock, check the company's ability to pay it and stay afloat. In any industry, anywhere, a careful amateur investor can find outstanding high-minus growth companies often before the professionals do. Everyone has the knowledge needed to invest, but not everyone has the courage. To succeed, you need both. If you panic during a crash and sell everything, then maybe you shouldn't be in stocks or even stock mutual funds. Thinking you'll make it big with one huge bet often ends with losing big instead. There's always something to worry about. Don't let scary headlines or gloomy predictions make you jump. Unless the fundamentals of your company have changed, don't sell out of fear. I like to find outstanding companies in dull industries. When an industry gets too hot, the competition gets so intense that nobody makes money. Buying at raw minus bottom prices may sound fun, but it's like trying to catch a falling knife. More often than not, you get hurt. A smarter move is to wait until the knife hits the ground, wobbles a little, and stops moving. Then you pick it up. If you're interested in turnaround stocks, make sure you have a real reason to buy. It's fallen so much it has to go up is not a strategy. As long as a fast minus growing company keeps expanding and there are no signs of major problems, I hold on to it. Don't sell too soon and miss out on a 10 minus bagger. Look for small companies that are already profitable and have proven they can replicate their success. Avoid hot stocks in hot industries. Even the best companies face tough times, and even in sluggish sectors, there are big winners. Diversification isn't always wise and often dilutes performance. When a stock is hyped as the next XYZ, it's a warning sign for both that stock and the original XYZ. If you can't convince yourself that a 25% drop is a good time to buy more, and instead react by selling in fear, you're unlikely to make serious returns from the stock market. Trying to time the market to avoid a bear runoff and means you miss the bull rally too. When the market drops sharply, I remind myself of the 40 crashes we've survived before. Each one was a chance to buy great companies at bargain prices. Stock market crashes are no surprise. They come regularly, like Minnesota winters. If you live in a cold climate, you don't panic when temperatures drop. You put on a coat, throw some salt on the sidewalk, and get on with your day. You say to yourself, winter's here, but summer is coming. The riskiest stocks, the ones with tiny odds of success, but promises of huge rewards usually just lose you a lot of money. It's often better to pay a higher price for a proven winner than to gamble on the next one at a discount. If a company's fundamentals are strong and future looks bright, don't sell it just because it seems fully valued. Business is dynamic. There is no such thing as a buy and forget stock. Selling in despair almost always means selling it cheap. I never put large sums of money into things I don't understand. I always look for outstanding operators in struggling sectors because when an industry is too popular, competition kills profits. Investing in cyclical stocks is like playing blackjack. Stay at the table too long, and you'll give your winnings back. When people stop wanting to talk about stocks, it might be a sign that the market is about to turn up. If 10 people would rather talk about dental plaque than mutual funds, it's probably time to buy. In the stock market, time is on your side. If you have money and aren't scared of declines, you can buy more. Don't worry about the next 10 days. Worry about the next 10 years. Overreacting to yesterday's news or clinging too tightly to one belief rarely helps in investing. A stock going up or down short minus churn just means someone else is willing to pay a different price. That's all. There's no better signal than when insiders are buying their own company's stock. Whether you buy stock at $50 or $1, if it goes to zero, you've lost it all. A 99% loss at $50 is no different than an 83% loss at $3. Both are disasters. Cheap stocks can still burn you. If you're convinced your stock is a guaranteed winner, the best medicine is often a sharp drop in price. People tend to believe things are so bad they can't get worse, but sometimes darkness falls just before it gets even darker. Before I buy, I take a few minutes to reflect. Why am I interested? What needs to happen for this company to succeed? What could go wrong? If I don't have enough conviction to buy more when the stock drops, I probably shouldn't tone it at all. The best investing tools don't come from Wall Street. They come from your life. Use your experience. Invest in what you know. That's how you beat the so-minus called experts. If I had to name the dumbest investing myth, it's this thinking a rising stock must be a good stock. Stocks are only safe bets if you're willing to hold them long enough to outlast the market's mood swings. In the long run, what determines your financial success isn't just how much you make, it's how much you save and invest. To succeed as an investor, you need patience, self-minus reliance, common sense, emotional endurance, humility, flexibility, persistence, the ability to admit mistakes, and most importantly, the courage to stay calm when everyone else is panicking. No one can predict interest rates, the economy, or the stock market. Ignore all those forecasts. Focus on what your companies are actually doing. That's what really matters.